to the Inspire Wealth podcast with Prof M, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Mallory Meehan, aka Prof M, and today I'm joined by Neal Bawa. Neal, welcome to the show.
Thanks for having me on the show. Very excited to be here.
Well, thank you. So, Neal, I know we were talking a little bit before the show, but how about you introduce yourselves, give us a little bit of background, how you got into real estate, and kind of what you're up to now.
Sure. Well, I am a data scientist by education, computer science degree. Basically, I've worked in Silicon Valley for a long time, running technology and education companies. I got into real estate in reverse. Most people start in real estate with a fix and flip or a rental. I got into real estate when in 2003, my company decided that we didn't want to rent a campus. Our lease was coming up and we said, let's just build one custom for us. And it was a technology and nursing college. And so my first experience in real estate was to build a 30,000 square foot campus from scratch, which was an absolute nightmare and an absolute delight at the same time, because, it's like boys with Lego blocks. And I made all kinds of mistakes. There were no investors. There was no loan. It was just all cash. So we made big mistakes, and we learned as we went. And at the end of that process, Mallory, I was a minority partner in that building, and I started to notice that my income was going upwards because this building was really kickstarting our business and growing it. And my taxable income was going downwards. So I started learning more about this thing called depreciation, which is this crazy concept in real estate that saves you enormous amounts of taxes. So we got hooked on that. I spoke with the senior partner and we started building more campuses. We built, I think between 2003 and 2008, 5 or 6 campuses were built or improved. And each time that happened, I was paying less in taxes, right? So I live in California. I have the big fat tech salary. And so I was paying, 40, 50% between state and local, taxes. And every time I would go deeper into real estate, I'd save more and more money, right? Because, one of the good sayings that you hear on the internet is, it's not about what you make, it's about what you keep, right? And I was now keeping more and more of my income. So by the time 2009, the crash came around, I had a lot of money in the bank. I was ready to invest. But as a data scientist, I understood that I didn't know anything about the single family market. I didn't know anything about the multifamily market, and I needed to learn. So as a data scientist, what's the next thing? You start gathering data. So in 2009, I basically launched a mission to gather terabytes of data from across the internet into a software called R, which is a statistical analysis software. And when I did that, that's when my journey started.
I love that. Well, we actually train our students in R, so that's very interesting that you said that particular software.
That's right. So, things have changed on that software back then. Back then, of course, it was much more rudimentary. And my goal was to scrape the internet for free information. So I would scrape, the predecessors of Zillow and Trulia and Rent.com and all of these sites. I was, scraping them for home price data. And then I would scrape the DOL, the Department of Labor website, which is a government website. I remember in 2009 getting a call from the FBI because the scraper that I was using, it was a Perl script. These days we write them in Python, but back then we used to write them in Perl, had basically crashed their website because we were gathering data too quickly. So they understood that I wasn't a terrorist or trying to do something bad. And they were like, you just make sure your script is running slowly. So then we had to actually slow our script down so we weren't crashing government websites. So we gathered terabytes of data and we put this into this software and we started asking questions. And the question that actually turned out to be the most important, we asked lots of questions, but the one that turned out to be the most fundamental was, what city in the United States is the best to invest in for real estate at any given point of time? Obviously that changes, the city changes. And what metrics, what parameters, what things are the most important when deciding which city is best for real estate investment, right? So if you think about the question, is really simple and logical, right? Because I'm the kind of person that I'm Indian. I came here in 1997 on an H-1 visa and became went through the whole 6-year process of becoming a citizen. And since you're from India, you don't have this mental block of I should only invest, in an 8 block neighborhood around me or in the same city. I didn't have that block at all, right? This is my adopted country, so I'm like, I don't care if I'm investing in Pennsylvania or if I'm investing in Chicago. I want to know what's the best.
Mhm.
But every time I would ask that question from anyone, even the most experienced people with 30 or 40 years in real estate, I would get ridiculously frivolous answers. Answers like, so and so place is great to invest. Okay, based on what? Well, I made money there, right? That was really the answer, right? Or my friend made money there, or 2 or 3 friends have made money. Well, from what I can see, real estate is so powerful that most people have made money in most states, but it's not the answer to my question. I'm saying what is the best and how do you measure the best, right? These days, of course, there's actually websites that measure this, right? And you can pay for subscription services, but I'm talking about 2008, 2009. I couldn't find any such services.
Mhm.
Um, and so I'm like, well, I'm a data scientist. Maybe I should gather the data and start asking the question and start looking at patterns. You mentioned this statistical analysis software R.
Mhm.
What this software really does is it tries to figure out correlations, right? What is a correlation? For example, if you're extremely beautiful, there is a high correlation that you'll end up in modeling or being an actor, right? Yeah, so there's a correlation there, right? If your car has a 1,000 horsepower engine, you'll probably have a high correlation to driving fast, right? So there's things in life that are correlated, and the software tries to find correlations by using data, and it uses past data to basically find these correlations. Long story short, I don't want to get too technical, but basically, there are 5 factors that have the highest correlation between, a city and real estate profits, right?
Okay.
Any city in the US, there's 1,016 cities in the US. And so when you're trying to look for a correlation between a city and real estate profits, there are 5 things that affect that the most. Now, there's probably 500 things that affect it, but these 5 are the 800-pound gorillas. And so the first one is population growth.
Mhm.
The second one is job growth. The third one is income growth. And the fourth one is crime reduction. And the fifth one is home price growth, right? Now, with all of these, there are, and these sound easy enough. Population growth, sure, that makes sense. You want to invest in a city that's growing. Yes, but that's not important. What's important is how much population growth leads to a correlation or increase in profits. Let me give you an example. Let's say your city, Pennsylvania. Let's say, the state of Pennsylvania is growing by 0.3% a year in terms of its population. Is that enough population to see an explosion in home prices? Probably not. What about 0.6? Well, now you're beginning to get closer. What about 1%? Oh, yeah, now you're getting really close. What about 2%? At what point
Mhm.
do you see this acceleration? Do you see this catalyst in everybody starting to believe, oh my God, a lot of people are coming in. We're going to run out of homes. Let's buy homes. And so everybody starts to buy home, and that drives up the prices. At what point does that happen for population? Now, same thing with job growth. If jobs are growing in a city or state by 0.5%, is that enough for people to start saying, we got to buy homes now, they're going to go up in value? Or is it 1%? Is it 2%? That's correlation. It's not just simply the factors that matter. It's when do you hit a tipping point where everyone around you starts to have a belief that prices are about to go up, because prices actually go up when people believe they do, right? So almost all of real estate is highly emotional in nature. So I found over 99% of all real estate buying is emotional, and most single family purchase, when people buy it for themselves, is not logical at all. If people say, well, we've made money from this, sure, in the last 20, 30 years, prices have gone up, so it's been a good decision for you. But when you made that decision, you didn't know about that prices would go up. You just simply assumed it. That's not a rational decision. It's an emotional one.
Okay.
So somebody like me that's a data scientist, we've studied the fact that most human decision making is emotional in nature. right? We're emotional creatures. We want to have a home and we want to find justification. My dad bought a home for $100,000 and it ended up being 600,000. Therefore, home buying is justified. Well, the question, if you're logical, would be, what is the chances that I will buy a home for 600,000 and it'll also go up to 3.6 million, 6x? Very low, right? Almost zero statistically,
Right.
but nobody asked those kinds of questions. So I was basically looking for that. And I found that these 5 factors were the ones that were separating the cities that were consistently producing the most profit. Back then for single family, now I'm involved in the multifamily world, but similar. And and then I was like, well, what about schools? And the answer was schools are an important factor, but if you factor in crime reduction, you end up actually having the same effect as schools. So I didn't want to have 100 factors. I wanted to have a smaller number of factors. So basically, I was ending up with the same list of cities, whether schools were in there or out of there, because I already had crime reduction in there. You see what I mean? So I was trying to basically filter out and say, what's the smallest number of factors that I can come up with that gives me the same result as 100 factors, right? Because who wants to do the brain damage of tracking 100 different things that affect, real estate prices? So I did that. And I basically said, I should share this with other people. That back then, this is 2009, 2010, I had no agenda, right? I was buying for myself. Madera, California, and luckily back then, Madera came up on the top of the 1,000 city list because it had fallen the most from 2005. So 2005 was the peak in Madera, 2009 was the trough. So it had fallen by 70%. That seemed to be, a good city to invest in. So I would basically run off to Madera and buy a property every month or so, every month or every 2 months. And I was buying them at pennies on the dollar, right? These are properties that where the cost of construction to build them was 250,000 and I was buying them for 90,000. So how could I lose? Everyone around me thought I was the biggest idiot of all time. Because in 2009, if you spoke with people and like with real estate crashing, if you told them you're buying something every month and you're just giving people whatever price they want, they would think that you were insane. But like my math is showing this is the best time in 100 years to buy real estate because I'm buying at 40% of the cost of construction, right? Eventually, the law of inflation says that the prices will go back up, but it wasn't very obvious to people. So I was a little bit of a pariah with my own family and friends who basically thought that I was completely insane. Luckily, I had data science on my side. So I'm buying all this stuff in Madera, California. And I'm like, I need to tell people about this stuff. I think other people need to know. I didn't have investors. I didn't have a real estate fund. I mean, I'm just a tech guy running a technology school and buying stuff using my own money. And I was like, but what I'm doing is very cool and I'm making money very, very fast. And my taxes are going down practically to zero. And I'm like, I should tell other people about this. And so luckily I was running a college and the college has large conference rooms. So I said, I'm going to open a meetup group. And meetup was something that was new back then. And so I opened a meetup group in one of my conference rooms. So luckily, my meetup group, I only had to travel 150 feet from my corner office to the conference room. So it was great. And so I gave this meetup group this really ridiculously stupid name, like it was some data analytics of real estate, blah, blah, blah. So the first time I did it, 4 people showed up. And instead of having a proper presentation, I'm just having like a conversation with them. As it happens, 3 of them are data scientists. Surprise, surprise. This is Silicon Valley, right? And you throw a rock, you're going to hit a data scientist. So these people are here, and we get into this incredible conversation that goes on for hours, and I'm sharing all of my data, and they're like, yeah, this is incredible. And some of them start to go to Madeira and Fresno and other places, and they start buying because these people are also, they're from Apple and Google, and they're making $300,000, $400,000 plus stock. So they all have money, and they're all getting crushed by the taxes. So they start doing it. And then somebody comes to me and says, can you give a better name to your meetup? Because your meetup's really awesome, but it has a shitty name. So eventually I came up with Location Magic, the best places to invest in real estate in America. And so the next time I hold the meetup, there's a dozen people. And then the third time we hold it, there's 100 people with standing room only, right? So, because like there's all these nerds and geeks in Silicon Valley, they're very curious what this guy Neal Bawa is saying. So I, start building this community that builds into thousands and thousands of people, and nobody's selling anything because, in fact, everything was banned. You couldn't pitch anything, you couldn't sell anything. It was just to share information, and it really accelerated because there was nobody had any agenda. People had a lot of money and they needed to share it, and the moment they would come in and I would show them the math, they would realize, oh my God, we should be buying as much as possible, right? People don't understand that this is an incredible time to buy. Um, so so that lasted and there for a while and I kept buying. I ended up buying like 14, 15 homes. And my biggest regret is I stopped buying at that point. I should have found a way to keep going and get more loans. Should have bought hundreds, right? And I only bought 14 or 15. Not that I'm complaining. I mean, you can imagine they're all, 4x, 5x what I bought them
Right.
for.
Right.
Um, and then one day, this Apple guy comes to me. He's already started making money from this idea. And he says, why don't you put this on the internet? And I'm like, well, how am I going to do that? I mean, I'm not going to go build a website. He said, no, no, it's much easier than that. There's this website called Udemy. So you go there and I'm like, okay, but I don't want to write anything. It's too much hassle. He says, no, 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 just, sit in front of a webcam and just talk, right? And there's this application called Camtasia that you can use to share your screen and your video. Just, turn on Camtasia. And I'm like, no, that's pretty sloppy. I'm the kind of guy that's doing degree granting courses. So I'd write curriculum and lesson plans. And he's like, don't bother with any of that, Neal. You're just trying to give information to people. Just turn on Camtasia, share your screen, and just talk. And I'm like, okay, fine. So one year for Christmas, I sit down, I put together this course, Location Magic, and 2-hour course. And I remember the first time I did it was horribly disorganized. Um, and so I publish it, and I'm like, maybe like 50 people will show up or 100 people will show up on this Udemy website. I had no idea how big this website was. Now there's hundreds of millions of people, taking courses on it. But before I know it, there's thousands of people. And then after a while, there's tens of thousands of people taking the course, and I'm like, wow, people really like this stuff, right? And I was excited about the 5-star reviews. Everyone loved the fact that there was no pitch. Um, and now I'm gathering a bigger and bigger database, and more people are beginning to learn about me. And so I start getting phone calls from conferences. These are real estate conferences, right? And so the people in these conferences are running funds of hundreds of millions or billions of dollars. And I'm like, so you want me to speak at your conference? And I'm like, yeah, we wanted you to do that. I'm like, I'm not a real estate guy, right? I'm a technologist. I don't have any investors or a fund or anything like that. And they're like, yes, yes. And I'm like, why? They're like, well, everyone at this conference is pitching something and you're not. So we want you to be the token nerd. Um, which which makes sense. And I'm like, yeah, but I'm not making any money. And they're like, don't worry, we'll pay for your airfare and your hotel and your conference ticket. And I'm like, this sounds like a really good deal. Now I know I should have been charging them a lot of money,
Oh
but
yeah.
I
Oh
didn't
yeah.
know that. I didn't know that, right? So I was like, oh, free conference ticket, free airfare, free hotel. Sign me up, I'm coming. So I start flying around to conferences around the US, sharing data science, and I start creating other courses and ideas and concepts. Then I start ranking cities, and I become very popular for ranking cities and speaking about them. The first city that I found that I spoke about in 2011 or 12 was Provo, Utah. I basically said Provo is going to be, the next San Francisco Bay Area. Then I started speaking about Austin, I think in 2012. Then Nashville, and so on and so forth. This is way before these cities got popular, right? and and people so got a reputation. Somebody then gave me a tagline on one of the conferences, the mad scientist of multifamily. By this time I was buying small multifamilies, 3 units, 4 units, 7 unit, 14 unit kind of stuff. um and so it started to snowball, and I did keep a list of all the people that were connected to me through Udemy or through my meetups or through my conferences, and the list was just growing and growing, thousands and thousands of people in it. And I, created a newsletter and would send a newsletter out 4 times a year. People would read it, and I get lots of comments from people thanking me about, they had gone out and invested in Columbus, Ohio, and were making money, or they'd gone out and invested in, some market like like Research Triangle Park in Durham, that kind of place that I was, pointing out to, places in Florida like Lakeland, that I was writing articles about. So it was really great. And I was continuing, with my technology and healthcare school. But then the senior partner, he hit 70 years. And so he said, I'm going to retire. I'm going to sell this college. And I was like, okay, he's the boss. He can do what he wants. But then obviously that meant that I would have a tax bill of millions of dollars. And given that I, live in California, almost 53, 54% was taxes. So I'm getting desperate. I know that in a few months, my business is going to be sold, and I will end up giving more than half of the money that I've earned like a one-time thing in my life, to the tax man. And so I started doing a lot of research, and I realized that multifamily is better than single family for, depreciation purposes. And so I go to my tax attorney and he says, have you heard about this thing called syndication? And I'm like, no, what's a syndication? He says, well, a guy like you that has a database of people that follow him buys a large multifamily property, maybe it's, 100 units, 200 units for, and puts it in contract. And these contracts, this is not like a single family thing where you have 30 days to close. Usually these contracts are 4 months long, 5 months long. And during that time, you go out and actually raise money. And so maybe you, for a $10 million property, you raise 3 million bucks, and you put in maybe a 500,000, and then your investors put in another 2.5 million, but you get 30% of the depreciation on the whole thing. And I'm like, why do I get 30% when I'm only putting in a fraction of the total money? He says that's because general partners in syndication get 30% of the profits and 30% of the depreciation. So with a small investment, you could wipe out, get a massive amount of depreciation. And I was like, this doesn't even sound legal, right? So I go and hire a lawyer, and the lawyer says, no, no, it's completely legal. People do it all the time. There's thousands of syndications. And here's a syndication lawyer. Just go talk with this guy. He's an actual syndication lawyer. So I go talk to the guy, and he explains the whole thing. It turns out it's completely legal to do all of these things. So I'm, in the year that my company is sold, I put a property in contract, and I'm thinking it's going to take me 6 months to raise the money. And I'm like really terrified because I mean, I have millions and millions of dollars at risk here, right? If I can't raise the money.
Mhm.
Well, it only took about 20 days to raise the money
Oh my
because
God.
these thousands of people that were following me, I'd never asked them for anything in all these years. So when I explained what I was doing, it was incredibly fast. It was shockingly fast. And since then, it sort of has snowballed where we have taken in about 325, $330 million from investors, 1,200 of them, and I've invested them into all kinds of real estate assets, multifamily value add, apartments, new construction multifamily. We've built townhomes. We've, built apartments, industrial warehouses, self-storage facilities, student housing, you name it. I mean, the ball just, it sort of snowballed from that point onwards. And 2014 is when I became a full-time real estate professional. So, 10 years now as a full-time, and then 10 years before that, either building campuses or buying single family. So, that's a journey. It's kind of a weird, unusual journey, but it is what it is.
No, I love that. I love that journey. It's awesome to hear, how different people start out different ways. So I'm curious now, what does your portfolio look like that you currently have?
So I don't have any single families except for the 14, 15 that I bought back in 2008. My wife has become emotionally attached to them,
So
unfortunately.
that
So
you
instead of
still have
selling them,
those. Okay.
I still do have own those. So she doesn't want me to sell them. So what I did was the next best thing. I have refinanced them and pulled out most of my equity because I have a lot of trapped equity in those, millions of dollars. So eventually I said, okay, she's not going to let me refinance, sell these. She's the property manager and makes a lot of money from it. So that's her thing.
Hmm.
So I've refinanced them, pulled out the equity and reinvested that equity. I prefer multifamily now because of scale. My typical property has 200 units. Um, is about $30 million and has about 6 employees at the site. So I usually have a property manager, two leasing agents, two maintenance staff, and a porter. And so by the fact that there's 6 employees on site that are doing all of the rehabbing, the upgrading, we buy properties that have laminate and we improve them to granite countertops. We'll change out the appliances, we'll change out the fixtures, we'll repaint the property, we'll rip out the carpet and convert it into laminate. Upgrades. And my upgrades are not like the sort of upgrades you do for single family. My
Right.
budget for upgrades is only 12 grand, 12 grand per unit, right? So it's the usual thing. Take out the carpet, replace with laminate. In some, replace the cabinetry in the kitchen and replace the countertops with granite. Um, and paint the place and make the faucets brushed metal faucets, change the lighting out, and that's it. And then you just rinse, repeat it. And the reason I can get it done for $12,000 is the maintenance staff are working for me, and I'm paying them, $27 an hour. So it's not like I'm paying them a huge amount of money. Most of my properties are in the Sun Belt, which is no surprise given its demographics advantages. So and then I build apartments as well. So right now I have a 320 unit approaching completion of construction and a 240 unit that's approaching completion of lease up, right? So the 240 unit is already built and I think half occupied. And now we're finishing up the lease up. And then I have a 320 unit that's almost all built and we're starting the lease up process. And then we continue to buy properties that are 70s or 80s properties. We buy them, we rehab them, improve them, hold them for 5 years, give depreciation benefits to our investors so their taxes are knocked down, and then we sell them. So, so far I think I've sold 9 of them and we've more than doubled our investors' money on those 9.
That's awesome. Now, do you do 1031s when you're selling, or how do you structure the exit?
The first 4 or 5 exits, we were not savvy enough to understand that we could do 1031 with multifamily. 1031 is actually straightforward to do with single family. You sell your single family, then you have 45 days to identify, 180 days to close. So single family, a lot of people know how to do 1031. For multifamily, it's extremely difficult to do 1031. But after the first 4 or 5 projects, another thing that I have regrets about because I should have 1031 that money, we learned that what you can do is on the day that you're selling the property, let's say you have 100 investors and only 50 of them want to continue on with the 1031. What you do is 24 hours before you exit the other 50 investors and give them their profits and they can pay taxes, right? And then the remaining 50 now own the rest of the property, right? And now you take all of them together in one LLC and move that LLC into a new property.
Right.
So the answer now is yes, we 1031 money, and not every investor goes with us to the next property because sometimes they want to buy a Tesla, they want to buy a home, they need cash. But people who don't want cash and they like the fact that we've just doubled their money, they just continue onwards with us into the next journey. So 1031 is a very powerful initiative.
Yeah, I love that. So I want to go back to your research and your 5 specific targets in order to identify, the best markets to invest. So is there a particular time frame that you generally see these cities kind of shifting where, this city might have been the best place to invest for the past year, but now, since that people have learned about that, now it's kind of shifting to that. Have you found any specific time frames, or what kind of research have you found based on those kind of shifts?
Absolutely. I think that one of the things that I find is a good way to exit is this. So here's a rule. It's a very straightforward rule. It's not super simple to get this data. And originally I was only obsessed with rules where I could get public data, meaning whoever used it should be able to get the data by themselves without ever talking to Neal Bawa, right? Imagine these 12,500 people taking Udemy courses. If they were to ask me stuff, I don't have the ability to answer all of their questions.
Right.
So the initial location magic toolkit that uses these 5 rules, and it teaches you exactly where to get the data. And it takes only 3 minutes for each rule to get the data publicly. So it takes 15 minutes to evaluate a city. So if you're evaluating 2 cities, it'll take you 30 minutes. So let's say you went to a party or in the office at the water cooler, they were saying Provo, Utah is the best investment in the United States right now. And somebody else says, no, it's Grand Rapids, Michigan. Well, how do you know? I mean, both could be shitty, right? So the answer is, you use the location magic toolkit. And again, I suggest you, go to multifamily university on Google, just type that in and go take the location magic course. Once you take the course, it'll take you 15 minutes. Actually, if you do it a couple times, it probably takes you only 5 minutes to do it for one city. So you can compare 2 cities in 10 minutes. You can compare 4 cities in 20 minutes. So I was obsessed with that. But then I realized that the question more and more people were asking me is the same question that Mallory is asking me, which is, when do I know when to exit? Like, okay, I rode the wave, but there's always a top. There's no city that is exempt from the laws of finance, right? At one point, I used to think that Austin would keep going forever. I was wrong. I mean, it crashed and burned. I mean, home prices are down, rents are down the most in the US. So no city is exempt, right? So from the laws of money. So you have to know when to exit. And my answer has been exit a city after its incoming construction supply hits 3.5% of inventory. So this one's a little technical, right? So what happens is that a city has a certain amount of inventory of multifamily or apartments. Okay. So let's say the inventory in Austin is 100,000 apartments. I don't really know what the number is, but I'm making it up. It's 100,000. So if Austin gets to the point where in each year, the total number of new units that are coming into the market, right, that are coming in are more than 3.5% of Austin's inventory, that is a good time to leave because that city has become a bubble, right? Because there's too many people building,
Yep. It's
right?
oversat.
Rents will fall. So just so you know, Austin currently is at 7%, which is why Austin has the lowest rent growth of any city in America. It's negative rent growth, 7.5% negative. So even though Austin has incredible jobs, incredible companies, it has Tesla, it has Oracle, it has everybody and their mother. Google is opening a massive new campus, but rent growth is 7% negative. So this is a great case study for people to understand that simply saying, I will invest in markets that have great jobs doesn't work. That's a silly idea to think that these cities will go on forever. They won't because everybody else is thinking that, right? So now where do you get this data? The answer is you have to have one broker friend that's a multifamily broker. So multifamily brokers, almost all of them subscribe to a software called CoStar. CoStar is very expensive, $30,000, $40,000 a year. For brokerages, they pay millions a year. But because this broker is like a Marcus and Millichap broker or one of the major brokerages, they have access for free. That's part of, their privileges. So they have access to a software called CoStar. So for any market that you like, let's say you like Grand Rapids, Michigan, find somebody that will pull that report for you. If you make friends and you tell them I'm interested in buying multifamily and say, hey, I really like Grand Rapids, I want to buy there. Could you pull me in the city report? They'll send you a big fat CoStar report, which is like 80, 90 pages, and you can skip most of it. It's actually great reading for people like I spend hours just reading CoStar reports because they're fascinating for me. But what you're looking for is the page that shows you incoming inventory. And it's a nice graphical page that shows you, okay, what percentage of this city's inventory is coming in. And if you see a number higher than 3.5%, perhaps it's time for you to find another.
Got
Right?
it.
I'm not saying the city will crash and burn just because it's at 3.5%, but I think it's getting its expansion is getting old in the tooth, right? So it's getting to the point where it's either going to slow down or it's going to reverse.
Right. Definitely.
So time to move on.
So have you found right now, like there is maybe like a handful of markets where you're still thinking, yep, these are where we're building, where we're going to stay at least for, the next couple years, or
The answer is always. So yes and always. The reason for that is there is this silly belief that there is a real estate cycle in the United States. That is a nonsensical idea. If there are 1,000 cities in the United States, there are 1,000 cycles. If there are 323 metros, there are 323 cycles for those 323 metros. So the truth is the United States, it's very rare to actually find two metros that are exactly at the same point in the real estate cycle, right? Because the cycle is very long, typically 10 years, 11 years, 12 years. And so cities are at different points. Another thing is that if you have a reset event like 2008, it resets the entire country, right? But if you don't have a reset event, what happens often is cities go up and then down, and then sometimes instead of going down all the way, they start another cycle. So it looks, you can look like, like this, just a sort of a regular sine curve, or sometimes it can just look like this. And you get two cycles or three cycles. Why? Because something happened in that city. Amazon moved in, Tesla moved in, somebody moved in that created a new cycle in that city, right? So it is it is trivial to find cities in the United States that are at the beginning of a cycle at any point of time because we have so many cities and because we have so many metros. So there are metros right now that are in the expansion cycle, even though most metros are not. So, because of the interest rates doubling in the last 2 years, Most markets are at the down portion of the cycle right now. Austin's a perfect example of that, but most big markets, Dallas, negative rent growth, Atlanta, negative rent growth, Orlando, negative rent growth, Nashville, negative rent growth, Phoenix, negative rent growth, right? So these superstar hot Sunbelt markets are all at negative rent growth. And you might say, well, my single family has positive rent growth. Yes, but if there's 100,000 single families in Phoenix, they have negative rent growth. So one example doesn't matter, right? So bottom line is that you have to understand where in the cycle a city is. So most great booming cities in the United States are right now at the bottom of the cycle. Prices for multifamily are down 30%. Prices for single family didn't drop at all in this cycle. They've actually gone up a few percent. Not anything fantastic, but they've gone up a few percent in the last 2 years. And so single family has become overvalued. Multifamily has become not undervalued, but properly valued because their prices have dropped 30% because of interest rates going up. Single family prices haven't dropped because there's no inventory in the marketplace. People like me are locked in at 2% interest rate, so we can't sell our homes, right? We're stuck. So the inventory in the marketplace has dropped so much that single family prices haven't dropped, even though they should drop. Because when mortgages double, right, your monthly payment doubled, right? Because home prices went up 44% in the last 4.5 years. They spiked a lot in 2021, 2022. Then they slowed down, but they were still going up. And then, interest rates double. So your mortgage payment has more than doubled in 4 years. Well, your income hasn't doubled in 4 years. US incomes since COVID have increased 19.6%. US, monthly mortgages have increased by 111%, right? 19.5% increase in income, which is actually a pretty decent increase in 4 years by itself. But then on the other side, you've got 111% increase in your mortgage. So this gap on the single family side is absurd. And the only reason single family prices are not crashing is because there's no inventory.
Right.
Because people like me, tens of millions of Americans used COVID to lock in rates in the 2%, 3%, 4% range. And so the market has very little inventory. Though some markets are loosening up, like Austin is negative rent growth, negative home price growth. Phoenix is negative. But for the most part, single family staying where they are. So people that are looking at multifamily, we actually are at the bottom of the cycle right now. So we're very excited and we're buying.
Well, that's great. And I know that obviously we have a issue with housing, not enough housing for the people that need it. And
Yep.
we were talking earlier about the American dream. Everybody wants to be able to own a home and live in a home. So tell me a little bit about what you personally are doing to kind of help solve that problem and help maybe allow that dream to be reached by more people.
Well, I'm glad you asked because this is where we start talking about my passion. So in the last decade of being a real estate professional, I have bought thousands of units, right? Hundreds of millions of dollars worth of property, and I've built hundreds of millions of dollars worth of property. And they're both good things to do because I'm taking really old product and renovating it so that it doesn't, just become, a crime scene. So it's a good thing to do. But eventually I realized that there was a downside to what I was doing. I was building new apartment complexes, and they were Class A apartment complexes with infinity pools and stuff like that. And now only people who are making more than $100,000 could afford to live there because my rents were, $2,500 a month, which is $30,000 a year. So to qualify, you have to have 3 times that much income. And so I'm like, I'm really catering to people that are renters by choice. What about the people that have no choice? Who's catering to them? And what I realized even before COVID was nobody was catering to them. Neither party, political party is actually interested in housing being a big issue, which it wasn't in this election, but it wasn't also an issue in the last election or even in the one before that. So it seems like housing is one of those third rails that neither party wants to touch, which is a shame, right? Because it's one of the biggest problems that Americans have. And housing and rental housing is 50% of US inflation. 50% of US inflation is just housing. And so but it's not a sexy area, and it's not an area that can get people, YouTube subscribers, so it doesn't get much attention. And so I looked at this and I realized something really bad was happening in this country. And, I'm an immigrant. I love America. I think it's the greatest country in the world. Sorry, India. But India is a great country. I love India. But I think America is the greatest country in the world. It still is at this point in time. And so I wanted to do something beyond simply renovating units and making them more expensive for renters. So I said, okay, I need to create new units. So I started building apartments. Then I started realizing that my apartments were super expensive. And basically, young tech geeks were living in my apartments complexes where I wanted middle America to live in them. So I became obsessed with this idea of like, there must be a way around this, right? Like, I mean, there's obviously cost of construction is very high because of inflation, but there must be a way around it. So years and years of research led me to realize that I couldn't actually do it in most parts of America. I couldn't create housing that was reasonably inexpensive for middle America. And so first I had to come up with a definition of middle America. My definition of middle America, very personal, is people and families making 60 to 90K, which means I'm really not thinking about the coasts. I'm thinking about, smaller states, could be Idaho and Utah and, Pennsylvania and basically North Carolina, South Carolina, but probably not, bougie parts of Florida, right? I'm thinking about people making 60 to 90K in the part of the United States where, dual income families make that, right? And these people, nobody seemed to be looking for any solutions to them. Now, before COVID, many of these people, especially in places like Philadelphia, where home prices are a little bit lower than other parts of the US, they were able to somehow figure out how to get that starter home and become homeowners. The United States has 65% homeownership rate, which is actually much higher than most other countries. And so people were somehow making that jump. Since COVID, though, that dream of American homeownership has been utterly, totally, completely destroyed. Why? Because of the two numbers I gave you. Since COVID, our incomes are up 19.6% and our mortgages are 111%. So 18 million American families that are in that 60 to 90,000 level simply cannot qualify for a loan. They won't qualify, right? They give their pay stubs and the mortgage guy says, I realize you have a down payment, good job. You still don't qualify for this loan. Your income needs to be 20, 30, $40,000 higher, almost $40,000 higher. Well, what do they do? Well, today, their only choice is to go live in Neal Bawa's apartments or somebody else's apartments, right? But they don't want to live in an apartment. They want the American dream, which is a home. And so I started to define what the most important elements of a home was. It turned out that it's really only three things that most people care about. This is done through surveys of my own tenants. Number one, nobody living above and below you. Number two, at least a one-car garage. And number three, a backyard, no matter how small. When you get these three things, Americans think of that place as a home. If you take away even one of these three things, they think of that as a transitional apartment on their journey to home ownership. But because I, as a data scientist, know that they will never end that journey of home ownership, unfortunately, it's very sad. Those 18 million families are going to be forever renters. So I decided that I'm going to build 10,000 townhomes for rent that meet those three criteria. All of them have to have at least one car garage. Some have two. Nobody above and below you because you're in a townhome, and have a backyard. And usually my backyards are only 10 feet deep, so they're not massive. But there's a little area there for the dog to poop, and there's an area for your barbecue and chairs for you to sit, and a fenced-in area so you feel like it's private. This, in my mind, is the alternative American dream today, because by building them in a small group of markets, and I'll explain why such a small group, I'm able to give brand new townhomes, 9-foot ceilings, granite countertops, to families that are making 60 to 90K in income. So all of the 10,000 townhomes, every single one of them is designed in such a way that no one ever needs an income above 90K. And most of them work for an income of 60K. Not all of them, but most of them. Like if you want a 2-car garage, you probably need a 75K income, right? And most of them are 3 bedrooms, though there are some 2 bedrooms in there as well. So I set my parameters and I said, my goalposts are 60 to 90K in family income. And I want to be as close to the 60K as possible for most of my units. But to create profit for my investors, I got to have some more expensive units in the property for people that make 75 or 80 or 85, so I can make profit. And the biggest challenge was after I set the goalposts, I realized most of America doesn't qualify. because the cost of construction, because of inflation, has spiked so much that I had to charge more than these numbers. I had to charge, $2,500 a month, which means you need more than 90K to qualify. So I said, okay, let me find the cities in America that are growing, so fast growth cities, but their cost of construction is low. And then other things that matter in the expenses of a property should also be low. What I found was there's actually only three things that matter: cost of construction, property taxes, and insurance. If you can keep these three things low, right, then I can be within my goalposts. So I launched an initiative as a data scientist to profile every city in America, firstly for all the growth parameters, we already talked about them. Then I said, okay, fine. So now I have these 100 cities, 200 cities that are growing. But within these cities, which cities have extremely low property taxes, extremely low insurance, and extremely low cost of construction, right? It threw out all of Texas, which sucked. It threw out all of Florida, which sucked even more. But I was still left with amazing markets in America that are still growing. Northwest Arkansas, which is Rogers and Bentonville, Reno, Nevada, Raleigh, North Carolina, Indianapolis and the suburbs, Kansas City and the suburbs, Columbus, Ohio, many other places like this work. Inside of Florida, only one city worked, Orlando. And the reason for that is its insurance is a little bit cheaper because of the fact that it's nowhere near the coast.
Right.
So when a Category 5 hits Fort Myers, by the time it hits Orlando, it's a Category 3, which doesn't cause flooding. So Orlando's insurance is cheaper. So I was able to make Orlando work. And that's what my life mission is. Now that I've found cities where construction costs are low, property taxes are low, insurance is low, I can now build these mid-market townhomes. These are not affordable housing. I just want to clarify. Affordable housing is a small, crappy, low attraction unit in an apartment complex that has subsidized rent. And developers do it because they get some property tax benefits from the government. That's called subsidized housing. I'm not looking for that. I'm looking to give people 3-bedroom townhomes that are 1,200, 1,300 square feet, right? With granite countertops and 9-foot ceilings. My job is much harder than a 1-bedroom apartment, which is easy to subsidize. I have no subsidies. No government employee, no government organization has given me a dime. My goal was, how do I do this profitably enough so that I never need to beg any city or state government for a dime? And that's what I've managed. And that mission is behind me on the screen here for those of you that are watching this on video. It's called Mission 10K. And we're doing swimmingly. If you go to my website, the first thing you'll notice is a beautiful video of a community. Now, beautiful is relative. I have many, if on the other link that you see on the screen, Grocapitus, you'll see much more pretty apartment properties. They're gorgeous, right? But again, that's an apartment complex, not a home, right? And so to me, a gorgeous community is one that has a 3-bedroom brand new townhome that you live in. You've got a backyard, you've got a garage, maybe 2 garages. And maybe you have some amenities, a dog park, maybe you've got a fire pit, maybe you've got a playground. These are not expensive infinity pools with massive clubhouses and huge gyms. I couldn't squish that into middle America's income.
Right.
So I didn't try, right? I didn't try. So I have inexpensive amenities. But you know what is so awesome? Nobody gives a damn. Every time I build a Mission 10K community, it leases up immediately. And then something awesome happens. It stays leased. I have apartment complexes that are way more beautiful, gorgeous, 4 floors, 5 floors, amazing, infinity pools. Every 2 years, I have to release the whole community. Every 2 years, people leave, and I have to, churn. And that takes away more than half of my profit, right? But that's because of the apartment mentality. People don't think it's their home. But whenever I build a Mission 10K community, people don't leave. They stay because they think it's their home.
Right.
And they found that in between new American dream. And they engage with their neighbors. The engagement in my townhome communities is 5x the engagement in my apartment communities, which is shocking. Given in an apartment, if you open your door, there's a door directly opposite you. So you should be engaging with that neighbor, right?
Mhm.
They're 5 feet away. They don't. But in a townhome, because all of the events inside the community are based on things like barbecues and celebrating the 4th of July and hot dogs and stuff like that. It's not amenity based, right? It's just bringing communities together. Everybody knows everybody. It's like single family homes. You always know your neighbor to the left and right. And because you've been living there for years and years and years, your relationship strengthens, right?
Mhm.
If you thought it was your home, you'd make an effort. And that's what I'm seeing in Mission 10K communities. So we have hundreds of investors that have joined us. We have communities that are very profitable, extremely profitable. And the biggest profit is because we're making them in markets where construction cost is cheap and we're not losing a lot of tenants. The tenants stay, even though we raise rents. It is not affordable housing. It is a for-profit initiative. But most importantly, I'm creating stock for middle America, tens of thousands. The moment I hit 10,000, Mission 10K will become Mission 100K. And by the time I hit Mission Million K, I think we would have solved most of the US's problems for
Love,
housing. I think we're 1.7 million homes short.
that's an awesome mission. I love your passion. How close are you to 10K right now?
We have, so we're in the first 3,000 units, but like everything else, we're snowballing, we're accelerating. So
Mhm.
we're now at the point where we're easily able to build about 2,000 a year. So
Okay.
I think that I can hit Mission 10K by 2028.
Okay.
And then from 2028 to 2038, I'll try and hit Mission 100K. And from 2038 to 2048, if I'm still alive, I will try and hit a Mission Million K.
Love that. Is there a way, are these funds that you're still raising, and can people get information on how to get involved with that?
They can. So the easiest way is to Google either one of the companies that's listed here. So Grocapitus or Mission 10K. So you can go to mission10k.com. Or I think the easier thing to do is to go to Multifamily University, just Google Multifamily University and join our community. And every year we do 12 very entertaining webinars. We just did one with 2,600 people signed up. It was the impact of Trump on real estate. So as you can imagine, it was very fun and contentious and interesting.
Mhm.
Went on for 2 hours with questions. Um, and so we do 12 of those webinars once a month. And every second or third webinar, we introduce an upcoming Mission 10K project for 1 minute, for 60 seconds during the webinar. So if that's interesting, you can get into whatever that project is because they change over time. So right now, the markets that work for us are Reno, Northwest Arkansas. As I mentioned, we're doing a lot in Raleigh, Orlando, and then Indianapolis and Kansas City. And again, I realize that some of these are not the sexiest sounding cities in America. I'm not going for sexy. I already did that,
Mhm.
right? I'm going for middle America homes.
Right. Love that. So I love all of the nuggets that you've dropped. Now, if somebody were to want to explore, doing some of this data analytics themselves, are there sites that you recommend or resources that you would suggest they go to in order to kind of do some of this research?
The first place to start is my Udemy course. It's free. Nobody will pitch you anything. You won't see anything about Mission 10K. It's just a course. It's straightforward. Doesn't tell you anything much about me, just a course. So type in Udemy space Neal Bawa, click on the first link. You'll see there's tens of thousands of people taking it. Take that, and it's about 90 minutes, and you'll learn a lot about real estate just through that course. Then I suggest you look at paid software. Unfortunately, software is not free, but I think there's a lot of value there. One that I like is Local Market Monitor, which is localmarketmonitor.com. I'm not affiliated with them. Another one that I like is housingalerts.net. I am not affiliated with them. These both have subscriptions, and you know, you might think a $99 subscription is expensive, but I want you to remember that this kind of data used to cost $30,000 to $50,000 a year in the 90s.
Mm-hmm.
It is the wonders of the internet that is basically brought prices down to pennies compared to what they used to be. So real estate professionals were used to paying tens of thousands of dollars. And for that, we would receive fat printed books. And we would still have to go through thousands of pages. Today, you get analytics, graphs, charts, email alerts, saying so and so city has, here's all the good stuff. Everything is a few clicks away. So if you don't take advantage of that and you don't think that $99 a month is, is way too much for me, then maybe you're not making the investment. People spend tens or hundreds of thousands of dollars to go to college. But college doesn't teach you how to make money. It teaches you how to be a better person and has lots of other benefits. But the one thing college seems to suck at is how to make money. And I think that these sites are designed to help people make money. And once again, I'm not affiliated with them. I just like them. These are smart people doing smart things. They're doing them better than I can.
Mhm.
And at some point, you have to, accept my job is to make my investors money. So I am an amateur still at data science. These people are professionals. They have websites. They're doing a better job than I ever could or aspire to do. So check them out. They're great places to start. There are other real estate courses on Udemy as well, but just be careful you don't get suckered into a pitch and start paying $50,000 a year for this or that membership. None of those memberships are worth it.
Love it. Love it. All right, Neal, this was awesome. Do you have any last minute recommendations, any books that you're reading or anything that you find to be valuable that our listeners might also want to check out?
Well, my book comes out on Tuesday on Amazon,
Okay.
and I
What is it
expect
called?
that. Actually, I should know that. Um, sorry. Give me a second. So it's called Lessons from Thought Leaders, and it has me and some of my friends that are sharing their ideas and their thoughts. So you can pick it up on Amazon. By the time this podcast is published, it will be on there. So I suggest that one. A lot of really smart people sharing thoughts there. Um, I think I also suggest that you pick up The Miracle Morning because it may not be your favorite book, but if you follow The Miracle Morning for a year, you will find your favorite book. That's what it enables you to do.
Love that. Love that. Well, again, Neal, this was such a pleasure. I love the work that you're doing. I love your mission. And, I'm excited to follow along and hopefully cheer you to that 1 million mark.
Sounds good. Thanks for having me, Mallory.
Absolutely. That wraps it for another episode of Inspire Wealth. We will catch you on the next one. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.